Hello and welcome. As you consider selling your home, you may ask, how will my home be taxed and for how much? As a home-based childcare business, there are two taxes that will apply to the sale of your home. The first is tax on the profit made from the sale of your home, and the second is tax on the depreciation related to your home business. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information are not intended to create, and receipt does not constitute, an attorney-client or any other advisory relationship. Reproduction of this information and recording of this content, including the use of AI, are expressly prohibited. Only non-commercial uses of this work are permitted. In today's conversation, we will discuss the two taxes previously mentioned: tax on the profit from the sale of your home and tax on depreciation. We'll also go over a few special circumstances that may come up regarding the sale of your home. Tax on profit is relatively straightforward. If you are a single filer, you are able to exclude $250,000 of the profit, and if you are married and filing jointly, you are able to exclude $500,000. To take the exclusion, you or your spouse must have owned the home for at least 2 of the past 5 years, and it must have been your primary residence for at least 2 of the last 5 years as well. In most cases, to determine the amount of profit from the sale of your home, you start by taking the price you purchased it for and subtracting the price you're selling it for. Any profit not excluded based upon your filing status is considered ordinary income, and it is taxes at the usual tax rate for your income. If you used your home for business, you may need to pay back some or all of the depreciation you were entitled to take on your property. There is no exclusion for the depreciation of your home associated with the sale of your house if it was used for business after 1997. Accordingly, regardless of whether you took the depreciation deduction year over year or not, you will owe depreciation recapture on any amount accrued after May 1997. To determine the amount of depreciation you can claim, start with determining how much of the depreciation is for the business. Take the purchase price of the home and multiply it by the time-space percentage. This equals the amount of the home's value would be depreciated through the business. Because we know depreciation on a home occurs over 39 years, divide the total depreciation by 39 to equal 1 year of depreciation. Then multiply the amount by the number of years you own the home to determine the amount that is subject to ordinary income taxes. As stated earlier, the tax on depreciation when you sell your home that was used for business happens whether you depreciated your home on your taxes every year or not. Many family child care providers do not take depreciation annually out of concern as to how it will impact their eventual sale, but it is going to be taxed regardless. If you didn't take your depreciation as a deduction every year and are selling your home, know that what you file the taxes associated with the year that you sell your house, you can also file a Form 3115. This is a form you can do with your tax preparer that will help you to claim any depreciation for your business that had previously not been claimed. So far, we have covered the more straightforward cases around selling your home. Now let's discuss some of the less common situations that may still affect you at the time of the sale. To start, the basis of your home sale refers to the value the home was considered to have at the time of purchase, and you would use for the purchase price when you sell. If you acquired your home as part of a divorce settlement, you are allowed to count the time that you and your spouse own the home as part of your 2 years that are required before the sale, and the price of the house that would be used to determine the sale would be the same price that you and your spouse purchased it for originally. If you inherited a home, typically you would use the same price that the person bequeathing the home to you purchased it for. However, there are special rules for inheritance in 2010, and if you've inherited from somebody who is not a spouse, the executor can adjust the basis, so talk to your tax preparer about the specifics. If you inherited a house from a spouse and you're in a community property state, such as Texas, Wisconsin, Washington, California, Arizona, Idaho, Louisiana, Nevada, and New Mexico, the basis is the fair market value at the time you inherited the house. Outside of a community property state, the basis would be the fair market value at the time of your spouse's death, multiplied by the percentage of the home you own. Several improvements can adjust the basis of your home, like adding a patio, or an addition, or expanding your home. In each case, you would adjust the basis of your home by taking the original cost and adding the cost of the improvement to create the new number. For more information, visit the Child Care Collaborative of Iowa website or email fmc@midsioux.org.